Hey, Kyle here with WinTheHouseYouLove.com. You might be looking at getting an FHA loan because it's a super flexible loan. It allows a 3.5% down payment, and it allows down to a 580 credit score, and even down to a 500 credit score if you're doing 10% down. It also is really flexible with a debt to income ratio, meaning if you have a lot of debt, it's easier to get approved for an FHA loan compared to other loans like conventional. FHA is a great option for a lot of people, but it can be a little bit picky on what it wants and how you can qualify. So I'm going to show you 11 FHA deal killers. First, FHA is extremely cautious about flipped properties. So this means that the seller bought the home and then flipped it quickly. So just it being flipped isn't a problem. What they want to take a look at is the time frame of how long ago it was flipped. Okay, so this is how this works. So we first have to figure out when the seller bought the home that they're going to sell you. How long ago did they buy it? If they bought it within 90 days ago, FHA is not allowed for those types of properties, even if they didn't even do any work to it. What FHA is calling a flip is not the work that they did inside of the home, it's just how recently they bought the home. So if the seller bought the home 1 month ago and then is trying to sell it to you, you won't be able to buy it with an FHA loan. Now, if the seller bought within 91 to 180 days, there's a little bit more restrictions on it. So FHA says that if the sales price is 100% more than the seller's purchase price, okay, so that means if the seller bought it for $300,000 and let's say that they're selling it to you for $305,000, then you're going to need a second appraisal, okay? So the second appraisal has to basically validate the first appraisal. The FHA basically wants to make sure that you're not getting ripped off through this flipping. So with the second appraisal, if it's 5% or more below the first appraisal, then the lower value must be used. So they're basically trying to look at two appraisals to validate the value of the home, and then they're likely going to use the lowest if it's 5% below the first appraisal or more. And then if it's 181 days or more, then there's no restriction on FHA loan approval. It's just standard like normal. Okay, so that time frame is going to be determined from the date that the seller's deed was recorded to the new signing date of the sales contract for your FHA loan. Now, there are some exceptions here to keep in mind. One is newly built homes. Those are perfectly fine. HUD-owned homes. So those are basically owned by FHA, which is HUD. And then also any inherited property. So it's something to keep in mind because sometimes this does become a problem, especially for flipped homes if you're looking for FHA. Also, if you have any federal debt, this is going to be an issue. So all FHA loans require what's called a CAVRS check. So CAVRS is the Credit Alert Verification Reporting System. Basically, it's tracking any default on federal debt. And since FHA is a government-backed loan, they're not going to give you a new loan if you're defaulting on current federal debt. Okay, so if you show up on this CAVRS report, you are ineligible for an FHA loan until that's resolved. So here's some things that can show up on CAVRS. One would be student loans, so federal student loans. All right, so these must be paid off, rehabilitated, or consolidated to clear the CAVRS listing. Also, if you have any IRS delinquent taxes, again, these have to be paid off in an installment plan, or if a tax lien is filed, a 3-month payment history is required to get an FHA loan. Also, child support judgment can show up here too. That has to be paid off or under a repayment agreement. And then also foreclosures can show up as well. And FHA has a 3-year waiting period from the foreclosure date to be able to qualify. Okay, so your loan officer, a lender, is going to be able to run this CAVRS report for you. Unfortunately, you're not able to run it on your own. There's really no other sites that let you run it. It has to be run through your lender. But if you show up on this, you won't be able to get an FHA loan until these are cleared, meaning they're either paid off or in some sort of repayment agreement. Also, home condition. Home condition is why a lot of sellers or real estate agents tend to shy away from FHA loans. FHA is fantastic, but they really want you to get a home that, think of it sort of like move-in ready. They don't want there to be issues. And there's really small things that can cause hurdles for FHA loans. And unfortunately, a lot of these are really small things that have pretty easy fixes, pretty low cost fixes, but people get really overwhelmed. I can't tell you the amount of times that an appraisal has come back and there's some chipping paint, and all that needs to be done is someone needs to scrape the paint and paint over it. And people will freak out about this. Okay. This is a lot of times it's a little patch. It's like maybe an hour's worth of work and $20 worth of paint. It's really not that big of a deal, but people freak out about this stuff. So I think if you're prepared, knowing that this could happen when you're out shopping for homes, you'll be able to address this before the appraisal happens. Or if these come back for the appraisal conditions saying that they need to be fixed before you buy the home, you'll know that it's usually not going to be a huge issue. Okay, so one is any active plumbing leaks. Okay, so if there's general plumbing leaks, anything outside of a tiny little drip, FHA is going to want that to be fixed. Okay, so think about evidence of leaks. Okay, if you see any water staining or things like that, the FHA appraiser is going to want to find what the main issue is so that that can be fixed. And then chipped or peeling paint is a big one. So for homes that are built before 1978, they can't have any chipped or peeling paint. However, if the home was built after 1978, any paint that exposes or paint damage that exposes the subsurface needs to be repaired. Anything else, chipped or peeling paint, if it's built after 1978, is fine. Also, the roof needs to have 2 years or more of remaining life. Any exposed electrical wiring just needs to be capped. It's crazy the amount of times that there's just exposed hanging wires in basements that aren't capped. Again, if that comes back on an appraisal, there's no need to panic. Go out, have the seller just go cap those up. It's really not that difficult. Also for appliances, so if they're going to remain with the home and contribute to its value, they need to be operational. So you can't have something like a non-operational stove if it's going to be included with the home and contribute to its value. Also, you can't have things like missing handrails where they're needed for safety. So if you have steps going down to the basement, there's going to need to be handrails down there. And then also things like broken glass. So cracked glass doesn't need replaced, but fully broken glass is going to need to be replaced for an FHA loan. Now, you by no means have to be an FHA expert or a loan expert to get pre-qualified for a loan. Our team works in 49 states, all except for New York, and we love to be able to help you take the next step to get pre-approved, to take a look at your loan options and what those numbers would look like as well. So you can go to winthehouseyoulove.com to get connected to our team. Just click this button right here. And then from here, what you'll want to do is just enter in a couple questions. Then you'll get connected to our pre-qualification team, who's going to get a little bit more information with you. And then we'll connect you with a dedicated loan officer to guide you through the process. And if you're also looking for a real estate agent in all of the US, if you'd like to get connected with a local agent, I've partnered with Home and Money that has a fantastic real estate agent referral network. And so what they do is they're going to ask you a couple questions to match you with an agent local to your area. So you just go through here and answer a couple questions about what you're looking for, like you're looking to buy. What kind of home are you looking for? What neighborhood are you looking in? And they'll match you with an agent that is ideal for you. And again, that's winthehouseyoulove.com/agent to get connected with the Home and Money agent referral team. Now, another big issue for FHA loans is large deposits. So when you apply for a loan, your lender needs to look at your bank statements. With FHA, they want to see 60 days, so 2 months worth of bank statements. And there's a few different laws and reasons of why they need this. But one, they need to source where you're getting the money from for your down payment and closing costs. They also have to make sure it's coming from a acceptable source here. Okay. So first, what is a large deposit? A large deposit is a deposit that's inconsistent with your income that could require documentation. Okay. So things like your payroll deposits, perfectly fine. But a random cash deposit is where underwriters are going to start to wonder, where did that money come from? Because they don't want you to take out a loan to be able to pay for the down payment and closing costs. Okay. So they have to ask and source where that money came from. So deposits exceeding 50% of your monthly income typically need to be sourced. And when I say source, what's going to happen is your loan officer is going to say, hey, I need to understand where this money came from. You'll explain that to them. And then usually what's going to happen is they'll write a letter of explanation where they're saying, okay, this is where the money came from. And they're going to back it up with some sort of documentation. So things that are acceptable are things like you might have a tax refund. That's perfectly fine. If you sold something and you can document it with a receipt, then that normally is going to be okay. However, just a random cash deposit from, savings, cash savings that you have, that's not going to work. Credit card advances, personal loans, that's not going to work. Okay. Now, gift funds and other non-recurring income sources are going to require documentation. So on FHA, what a lot of people will do is they'll actually get gifts from family members to help pay for their down payment or closing costs. That's perfectly fine. That just has to be documented correctly. So talk to your loan officer before you get that started. Also, 3 to 4 unit properties, this can be a really big issue with FHA loans. So FHA is great because it allows you to buy a 1 to 4 unit property as your primary residence with only 3.5% as a down payment, right? So that's really great, especially compared to 2 to 4 unit properties. You can buy a home or buy, let's say a 4 unit property, live in 1 unit and rent out the others with only 3.5% down. So you have other people help paying for that mortgage payment. However, FHA has this really annoying thing called a self-sufficiency test. And what this means is they need to make sure that the rental income from all of the other units can support your mortgage payment. So the net rental income is what has to cover the mortgage payment. So how this works is an appraiser is going to assess what's called the fair market rent. So they're kind of going to do, think of it like an appraisal to figure out what your property would rent for. And then they're going to apply a vacancy factor. This is usually 25%. So what this boils down to is they're going to take a look at, okay, this property that you're buying, what do they think that it could rent for in the market? So I'm going to use really easy numbers here. Let's say that they think it could rent for $1,000 per month. Now they're going to apply a 25% vacancy factor. So we take 75% of that number, that's $750. That's what they're now going to project as your net rental income. Okay, that has to be able to cover your entire mortgage payment. If it doesn't, then you're going to have to increase your down payment to make the mortgage payment lower so that works. Okay, so this can be really tricky with FHA loans because, again, they have this self-sufficiency rule. So for a lot of people, they want to buy a multifamily home with FHA. You usually will need to have a larger down payment than 3.5% to make this work. Okay, so just keep that in mind that often home buyers are going to need more than the minimum down to be able to purchase. If you need help with this math, just shoot me an email and I can give you some examples of how this works. Now, FHA is known for being one of the more flexible options. However, it doesn't mean that everything is approved and everything is going to work. There are some things that you need to keep in mind, especially around things like collections, bankruptcies, and other credit issues. Okay, so for Chapter 7 bankruptcy, this needs to be discharged for at least 2 years. And also you need to have reestablished credit with no new credit issues. So for Chapter 13, if you're 1 year into your repayment plan and you've had on-time payments, as long as you get court approval, you'll be able to get an FHA loan. For foreclosure and short sale, it's going to be a 3-year waiting period. And what's really nice about FHA is for medical collections, they're excluded from the debt to income ratios, meaning that if you have medical collections, they're effectively ignored. So they're not going to impact how much of a loan that you can get. Now, for normal collections, if you have a total unpaid balance of $2,000 or more, you either need to pay those off, set up a payment agreement that's documentable, or the 5% of the balance needs to be included in the debt to income ratio. So sometimes this is an issue. It depends on how big the collections are. But if the collections are large, that 5% really can impact how much of a loan you can get approved for if you have those collections. Now, job gaps is another issue that can pop up with FHA as well. FHA has this pretty standard rule that says borrowers, so people applying for a loan with employment gaps exceeding 6 months, must provide documentation explaining the gap and demonstrate at least 6 months of stable employment in their current position. So that means if you've had a job gap of 6 months or more, then you need to be on the new job for at least 6 months to be able to qualify for an FHA loan. Short appraisals, another big issue that can come up with FHA and frankly any other loan. But first, whenever a short appraisal happens, this is when, let's say you're looking at buying the home for $300,000, an appraiser goes out there and he says the home is only worth $290,000. Okay, there's a $10,000 gap. That appraisal came in what we call short by $10,000. So a lot of buyers think that's great. I get to buy this home at a discount. The problem is you signed a contract at the beginning saying that you're going to give the seller $300,000. So for a lot of contracts, that falls through with short appraisals. So FHA has this very specific protection called an amendatory clause. And what this does is it allows you as the buyer to back out if the appraisal is lower than the purchase price without losing your earnest money. Okay, so if your contract, let's say you bought with a conventional loan and you didn't have any sort of appraisal contingency clause in your contract. Well, if that home appraises short and then you back out of the deal because you don't want to cover, maybe the seller is saying, no, I want $300,000 and you're going to have to come up with that $10,000 extra. Maybe you're saying, I don't want to do that. In that instance, you may back out of the contract, but you could lose your earnest money, that money that you put up front as kind of good faith in the contract that you're going to follow through with it. However, with FHA, all FHA loans require this amendatory clause so that no matter what the contract says, the amendatory clause is going to supersede the contract, saying that no matter what is on the contract, if the appraisal comes in short, the buyer is allowed to back out without losing any of their earnest money in the process. Okay. So FHA is going to require that if the appraisal is lower than the contract price, the borrower may renegotiate or pay the difference in cash if they choose to proceed. So something to really keep in mind here with short appraisals is that the lender isn't going to cover that gap with a loan for you. That has to come up with your own money. So think of it almost like an even bigger down payment to cover that gap if you want to buy the home, because a lender is only going to give you a loan up to what the appraised value is based on your down payment. They're not going to give it to you, above the appraised value. That's why they have the appraisal in the first place. So you could either cover that difference yourself, or maybe you work out a split with the seller. Maybe the seller comes down to $295 and you agree on that price. So the seller effectively gave up $5,000 in proceeds and you contributed an additional $5,000 to make up that difference. And I know it can be really confusing. Feel free to just shoot me an email if you have any questions, or just leave a comment down below and I can help you with some of this. Also, condos can be a little bit tricky with FHA. So condos have to be FHA approved. So they either need to be on the FHA approval list, or they need to have what's called a HUD spot approval. So HUD spot approval is where that condo is not on the FHA approved list, but your lender then needs to kind of dig into the condo association to see if it can qualify for FHA loans. And the reason why they do this, I know it's annoying, but they're really trying to protect you because a lot of condo developments can be run pretty poorly, and that can put you in some pretty hot water really quickly. And if you're in that situation and you still have this loan that you have to pay back, but this condo now doesn't meet basic livability standards, or there's litigation against the condo, you could run into an issue where now you have this huge loan to pay back, but the property that this loan is secured by isn't adequate and isn't livable. And so that's really the goal of why all these restrictions are in place. So FHA says condo developments must meet FHA's minimum requirements for owner occupancy, financial health, and insurance requirements as well. The amount of times I've seen people look at buying a condo and then the condo doesn't get approved because it's run poorly really is saving them from a lot of headache in the future. So with FHA, they're even looking at things as detailed as like projects with more than 15% of units that are delinquent on their HOA dues may be disqualified. So there's tons of other restrictions with condos as well, but something to be mindful of. If you're looking at a condo with FHA, make sure you're working with your loan officer to know exactly what you need to be looking for in the condos that you're looking at. Declining income also is kind of a big deal with FHA and a lot of other loans as well. So what lenders are looking for and what underwriters are looking for is they want to see that you have consistent income that's likely to continue over the next 3 years. That's kind of the gold standard for what underwriters are looking for with your income. They want to know that you can qualify now with your income, and over the next couple of years, you're still going to be able to pay back your mortgage, right? So for declining income, over the past 2 years, lenders are going to use the lower, more recent income figure. So for instance, let's say last year you made $80,000 and this year you're going to make $60,000. Well, the underwriter isn't able to average, they can't add the two together and average over 24 months because it's not a true depiction of the income. Your income now is at $60,000 and they want to see what changed? Why is the income at $60,000? How do we know that next year it's not going to drop to $50,000 or $40,000? Why is the income declining? They want to get basically some documentation or maybe an explanation of why the income declined and why it's likely that income is going to stabilize and be predictable and consistent in the future. So for home buyers, your loan officer, if your income has declined, is going to want a written explanation for why your income declined and maybe some documentation. They may ask for things from your employer for that as well. So the lender then is going to assess your income stability based on current trends and the nature of your job. So something to be mindful, if your income has declined over the past 2 years, it doesn't mean that you're immediately disqualified for an FHA loan. But just know that your loan officer and underwriter are going to want to ask, okay, what happened? And they're going to help try to figure out how can we show the underwriter that your income is consistent and stable over the next few years so you can get qualified for the loan. New construction also can cause a little bit of a hiccup here. So new construction is a little bit different than custom built homes. So new construction is where a home builder already has built the home and then you just get to buy it after it's constructed. Or maybe you're working with a builder and you get to customize a home and they're building it for you and you buy it after it's built. A custom built home is where you're financing the construction with a construction loan. New construction is where the builder is already building the home or they're in the process of building the home, even if you get to customize it, but you only buy it after it's built. You don't finance the construction. So if you're going to buy a new construction home for $500,000, then your lender is going to want to make sure that that home is worth $500,000. Okay. So what they're going to need to do with new construction is they need what are called comparables. So every appraisal is basically looking at usually 3 other comparable homes. So usually similar square footage, similar features, similar beds, baths, to compare the value of those homes to this home that you're buying. So with new construction, it can be a little bit tricky because there's some requirements here. So at least one has to come from outside of the subdivision, which normally isn't terribly difficult to do. But one has to come from within the subdivision as well. So this is where things get tricky, is because when you're buying a home in a subdivision that's been around for a long time, it's pretty easy for an appraiser to take a look at, okay, here's your home, and then maybe a home a couple streets down was similar, and they can use that as a comparable for the value of your home. However, in a new construction development, that can be tricky if, let's say, you're the first person in there, or maybe your home, there aren't similar comparable homes that have sold in that subdivision that are similar to yours. So that can be tricky with FHA loans. It's a very rare scenario, but something to keep in mind if you are looking at new construction. So if there isn't a comparable sale inside the subdivision, FHA financing won't work for new construction. I know it can be overwhelming stepping into this next stage of wanting to buy a home. You're likely going from, I'm thinking about buying a home, to, okay, I know I actually want to do this, and we would love to walk alongside you with this and help you get pre-qualified for a loan. Most of these things that you see in here are not going to be issues for you. They're good things to keep in mind. You don't have to be a loan expert to get pre-approved. So all you have to do is go to our website, winthehouseyoulove.com, click this button here, and then get connected with our team by filling in this, and then we'll shoot you an email and text to guide you with the next steps, getting connected with a loan officer. That way you can get pre-qualified for a loan, and then you can go out and start shopping for homes that you know are within your budget and you can qualify for. If you have any questions, feel free to email me. It's kyle@winthehouseyoulove.com, or you can leave a comment right in the description, and I answer all of those.